You're welcome to FSM1 event where we help investors invest globally and profitably. My name is Harriet, Client Investment Specialist from FSM1, and I will be the MC for tonight. The AI-driven solution provides the investor with constant exposure to the global technology sector through the long-only equity investments. Our topic today is leveraging the power of AI to deliver the Shariah-ESG investment opportunity within the technology sector. And we have with us today Mr. Nicholas, Director in the Business Development Team of the Arabesque. Mr. Nicholas is based in London. He is responsible for funds distribution in addition to assisting with new strategic partnership opportunities. So prior to that, he was based in Singapore, where he looked after the APAC funds distribution and helped to establish the office. So Nicholas holds a Bachelor of Science in Economics from University College London and is a CFA chartered holder. Now, without further ado, let us welcome Mr. Nicholas. Welcome.
Thank you very much, Harriet, and thank you to everyone dialing in this evening. I'm pleasured to be your Wednesday evening entertainment, so I'll try and keep this presentation short, snappy, and relevant. So the structure of today's session is going to be talking to you a bit about the opportunities that we see within the technology sector. Then we'll be talking a bit about our answer to these opportunities, so the BIMB-Arabesque Technology Fund, which we're going to be going into in a bit of detail. So talking about performance, positioning, and then finally answering any questions you have. So with that, I'll share my screen and go straight into the presentation. So before I talk about technology and the fund offering itself, I want to give you a bit of background on BIMB and the partnership with Arabesque. So as Harriet mentioned, I work for Arabesque Asset Management. We're a UK-based financial technology company orientated around sustainable quantitative investing. And in 2015, we partnered with BIMB Investment, which is the asset management arm of Bankers Lam. And one of the big reasons for our partnership was to bring Shariah-ESG investing to the Malaysian marketplace. So whilst now it's commonplace and we see a lot of the GLICs and big institutional investors in the country and the wider region adopting a Shariah-ESG approach, back in 2015, for our partnership with BIMB Investment, a dedicated Shariah asset manager, who were one of the pioneers in terms of this philosophy. So we're very proud of that. And together with BIMB, we've launched a number of fund offerings, global, regional, local. So today, we're going to be talking to you about our most recent addition to that fund offering, which is giving investors exposure globally to the technology sector. So we launched this fund in Q1 of last year. And the response we got from the market was what you see on the left-hand side. Oh no, not another technology fund. And giving you a bit of context of why that was the reaction, it's basically because there was a big drawdown, if you remember, in 2022. If you remember the headlines, every month or so in 2022, technology was not in favor amongst investors. There was a large sell-off, and this was prompted by an increase in interest rates. So when we first launched this fund, we were very excited to launch the fund in Q1 of 2022. We launched it, and the reaction we got from clients, remarkably, was, oh no, not another technology fund. This is possibly the worst time to launch a tech fund, because they were constantly looking at the headlines. And the reason why there was a large drawdown in technology stocks is because interest rates had been extremely low for multiple decades. And in order to tackle inflation, central banks were forced to increase interest rates, and that impacted growth stocks a lot, given that growth stocks drive a lot of their value in the future, and therefore you can discount that future value back at a greater rate if the interest rate is higher. So technology sold off a lot. But what we made sure that investors understood is that they shouldn't just look at the short term. They shouldn't just look at 1 year of performance when thinking about investing into a fund. They should actually look at the long term and look at the fundamental reasons driving really the positioning of that particular fund. So whilst in 2022, World Info Tech, MSCI definition, was one of the worst performing sectors and severely underperformed the larger market, whether that's the MSCI World Developed or MSCI All Country World Index. Over the long run, remarkably, in the last 15 years, MSCI World Info Technology has outperformed the broad market 11 out of those 15 years. So this is what we made sure that investors understood, that they shouldn't just focus on what was happening last year in headlines. They should look at the long term and try and understand why technology has actually outperformed the broad market and why possibly it can continue to outperform the broad market at such a rate going forward. And these were some of the key reasons that we gave our clients. There's large technologies, innovative technologies that are being implemented across society. So whether that's in financial services, whether that's in manufacturing, whether that's in leisure, retail, these industries are undergoing a digital transformation, and that's been driven by efficiency gains and boosting revenue whilst reducing costs, so increasing overall profitability. So on the slide, by no means do we have an exhaustive list of innovative technologies. We have artificial intelligence, we have blockchain infrastructure, and on the right-hand side, we have Internet of Things. So these are just 3 examples of very innovative technologies that are being implemented across our economies, which we got from Forbes. But of course, there are many, many more. And what I find remarkable, if you look at the left-hand side, this is a Ford manufacturing plant. So just the way Henry Ford pioneered efficiency more than 100 years ago with the production line, today in Delaware, as you see where that production line is actually happening, Ford are utilizing artificial intelligence to further make efficiency gains in the production of cars. If you think about blockchain, this is a technology that underpins cryptocurrencies as well as other forms of payments, and it's also making huge efficiency gains. And on the right-hand side, I found it quite remarkable when I was on my last business trip in Malaysia that I could control my heating, my central heating in my flat in London, whilst being several thousand miles away. So we can see these clear applications of technology in our everyday lives. And obviously, that's very good for the tech sector, which gives exposure to these adoption of these technologies. So I gave you some macro factors there, but if we look at some micro factors, the actual businesses themselves, and take things into a more granular detail, there's also some very good rationale of why technology stocks in particular are uniquely positioned, and explains part of this outperformance we saw in the previous slide. Why is technology performing so well? So on a micro level, we have extremely scalable business models, and within technology, this point I'm about to make is a bit more relevant towards software, so software as a service. And what you have here is a very low cost of sales. So you have high gross margins. So if we think about a company like Spotify, for example, for Spotify to onboard a new client, that costs almost no money, but it generates the license fee from that client paying to use the Spotify service. So you can see that having a low cost of sales, but getting that additional marginal revenue is extremely good in terms of gross profit margin. So this is part of the reason why software services within the technology sector have performed so well, because once you've got your basic platform, your business model, your product, it costs almost nothing to onboard a client, but you get a lot of marginal benefit from that license fee. Also, technology stocks, and partly because of the first reason I've just given, high profitability, they have large research and development budgets. So if you think about Apple, for example, or Meta, the parent company of Facebook, Instagram, and Snapchat, these companies generate a lot of cash. So they have a lot of reserves. And what that enables these companies to do is invest for the future. So this is part of the reason why these technology companies have got bigger, bigger, and bigger, and are approaching trillion-dollar market caps, is because they've invested so much into the future. Apple didn't just stop at the iPod. It went into the iPhone, then it went into the MacBook, then it went into the AirPods, then it went into the iWatch. It's always been investing for the future. And this is partly because of the strong cash flows, which enable a large budget for research and development. So I gave you some macro factors, as well as a couple of micro factors as to why these stocks are uniquely positioned. So what's different about 2023, and you've probably seen this from a big recovery in technology stocks since last year, 2023 seems to be the year of AI. So we've heard AI being spoken about a lot. You know, AI has always been a buzzword that's been floating around gradually, as you can see here. But in the last year, the popularity of the term AI has exploded. And that's really been driven by generative AI, and in particular, the application of ChatGPT. So ChatGPT, I'm sure many of you on the call today have utilized it, is incredibly powerful. A bit different to previous AI applications, ChatGPT enables the creation of new content from scratch, hence the name generative AI, which is the wider field of AI, which ChatGPT comes under. And it's had huge application. I've personally benefited from ChatGPT in terms of rephrasing emails, helping me to research particular companies or markets. And I'm sure you and some of the people who've dialed into the call today have also benefited from AI. And if you look at polls from different industries, they also see huge benefit in technologies such as generative AI in their everyday workflows. For example, at Arabesque, the company I represent, we're starting to look at how generative AI can help us create commentaries, which then we can use in our fact sheets. So basically automating PM commentaries in our fact sheets. So that's one application, but of course, there's applications in other industries. And also industries that people thought weren't previously being able to be disrupted by AI. So if you look at, for example, the music industry, a lot of musicians at the moment and artists are terrified that AI could essentially replicate their songs and create new songs with the same sound and the same theme to who they are as a musician. So we're starting to see AI really impact industries which we thought previously couldn't be impacted. And that's also relevant to the creation of new content, marketing materials, branding, etc. And as a result of this, we've seen companies related to AI, in particular within the technology sector, perform extremely well. So if you look at this graph, for example, it shows the year-to-date performance of S&P 500 information technology. So basically the biggest technology stocks within the United States. You can see a staggering 44.7% performance year-to-date. So this really goes back to my point that you can never really time the market. Last year, when we launched this fund, you know, everyone thought, oh no, not another tech fund. Technology is not in favor. Now is a bad time to invest in technology. We don't want to hear about technology. And we tried getting our investors to think about the long term, 11 out of those 15 years. And instead of focusing on 1 year of performance, focus on the key drivers of what's been causing that long-term pattern and whether that was likely to persist into the future. So when we saw this big rebound year to date, were we surprised? No. Have we been happy with the performance? Yes. Did we kind of expect this? We didn't think it was going to happen so soon, but we did believe in those long-term drivers of the technology sector. And that's what caused us to launch the fund. So we weren't overly surprised when we saw a large rebound driven by AI stocks within the technology sector. Because we always believed that these technologies, artificial intelligence, blockchain, Internet of Things, and others would continue to dominate our everyday lives and be applied across our economies as we undergo a digital transformation. So some of you on the call are probably asking, well, that's all well and good, Nick, but is there still opportunity? We've had a huge rebound year to date. Yes, you say long term, but maybe stocks at the moment in the technology sector are overvalued, and now is not a good time. So I think here, it wouldn't be a full comprehensive session on technology if I didn't talk about interest rates and inflation. So I just want to talk a bit about what potentially could happen going forward. So Arabesque doesn't actually have any official outlook. We don't have any in-house views. We're a quant manager, bottom up. utilizing data and processing that data using quantitative algorithms to calculate the most attractive stocks to go into. But what we've seen in a lot of commentary is that interest rates increasing over the last year has started to bring down inflation. And as inflation comes down, interest rates, the pressure from central banks to further increase interest rates is weakening. And therefore, in time, we could expect a reversal of interest rates as inflation continues to come down. So at the moment, interest rates are in the region between 5 and 6%, depending on the central bank you look at, the Fed, Bank of England, the ECB. So what a lot of commentators are expecting at the moment is the possibility that interest rates over the next year can plateau and then start to come down to what some people in the industry deem as a pivot. And should this happen, those sorts of conditions have traditionally been very favorable towards growth stocks and in particular technology. So whilst interest rates going up has traditionally impacted technology adversely, like we saw last year, the reverse could be a good thing for technology stocks if we look at what's happened historically. So the possibility of interest rates coming down over the next couple of years could be a favorable environment for technology stocks. So once again, this is not an official outlook from Arabesque. This is just some thoughts and insights based on what we're seeing of commentary in the market by other players. Great. So that was concluded the first part of the session. In that part of the session, I spoke to you a bit about the philosophy. You know, what's the rationale for getting exposure in technology? Why technology? That was the question I was trying to answer. So now I'm going to be presenting the BIMB-Arabesque Global Shariah-ESG AI Technology Fund, or for short, what we call as BGSEA. And this is our answer to that opportunity that we see in markets. So in terms of the key positioning points, the fund identifies the top performing Shariah-ESG technology stocks globally. So it allocates between 50 and 60 stocks, depending on the rebalancing. It also has a strong emphasis on risk management. So it doesn't take as much risk as some of the other technology funds we see out in the market. For example, it limits weights, for example, around 5%. It also places a big emphasis on diversification, on going into different countries. So it doesn't take a lot of concentration risk. Pretty different to some of the other funds we see in the market, which invest just in technology, which can go up to 10% max weight in a particular stock. That's not the game we're playing. We play a more diversified game, a bigger emphasis on risk management. So what we've seen when we look at historical simulations is that this fund takes on a less risk than some of the other funds in the market. And risk there is defined as volatility. Also, it wouldn't be a session by Arabesque without talking about sustainability and Islamic. So this fund also integrates ESG considerations in a best-in-class approach and also is compliant with the EOFI rulebook. So removing companies in non-halal business activities, as well as companies with excessive leverage, interest-based investments, and high receivables. So actually, when we launched this fund, it was the first Islamic global technology fund, and I believe still is, in the Malaysian marketplace. It's a very clear differentiator versus what else is out there. We're also very glad to win from the Edge Malaysia last year, the Best Fund Awards. We won the overall winner for this particular fund from the Edge Malaysia. And that was a response to its very clear differentiation in the market as compared to what else was out there. The fund is available in the following share classes: so MYR, MYR hedged, USD. The stated benchmark is MCI Acqui, information technology, and it's 1.8% management fee with a sales charge of up to 5.5. So obviously, if you're interested in this fund and require further information and insight and advice, please contact IFAS. You can refer you to BIMB Investment or reach out to BIMB Investment directly. How does the strategy work? Well, it follows quite a simple three-step investment process. So sometimes you might think, okay, this is overwhelming. Quantitative investing, that sounds a bit too complicated. I'm not comfortable with this for my clients. If I can't understand it, how can my clients understand it? So what I'm going to try and do with this slide, slide 11, is really provide a bit of transparency over the investment process. So we follow 3 basic steps. In step 1 of the investment process, we determine our universe. So this is basically the eligible list of companies we can pick a portfolio from. In step 2, we work out what stocks are most likely to make us money. And in step 3, we create a portfolio based on that analysis in step 2 from that universe in step 1. So basically step 3 is bringing together that step 1 to step 2 to create a portfolio of the 50 best stocks from the technology sector that are most likely to make us money on a monthly basis. We do control for some other factors. So of course, in step 1, we have the ESG integration. We have to make sure our universe is Sharia compliant. In step 2, we're using a lot of fundamental and macro analysis to calculate the expected return for the stocks, so the stocks most likely to make us money. And in step 3, when performing that optimization, we also look at controlling risk, ensuring diversification, also looking at transaction costs. Why do we bother with ESG? So it's not just this fund. As I mentioned, when we partnered with BIMB Investment in 2015, we brought Sharia compliant ESG investing to the Malaysian marketplace. We were one of the pioneers of ESG in the Malaysian market. And the reason why we do it is not to save the world or because we're tree huggers. It's because we think there's a performance edge in doing so. So we see ESG analysis, sustainability analysis, non-financial data is supplementary to your traditional financial data when conducting an overall assessment of a stock's attractiveness in terms of performance. So whereas traditional portfolio managers just look at classic financial data, ratios, statements, the macro outlook, analyst estimates, etc., we use all of that data as well as more. And we go into the sustainability data, supplement that financial data. So we look at a company's ESG score, so because we believe there's a link between ESG and a company's future corporate strategy and financial performance, as well as quality of the management. We look at the United Nations Global Compact, because we believe that companies violating any of the core pillars of the UNGC, human rights, labor rights, environment, anti-corruption, are companies that aren't behaving well and therefore could be exposed to reputational risk, which could damage performance. We also look at companies' carbon footprint. Regulators are increasingly clamping down and trying to meet net zero commitments by 2040, 2050, or 2060, and therefore are putting a lot of pressure on high emitting companies. So we look at all of this data, as well as your classic financial data, when calculating an overall company's stock attractiveness. So in terms of the performance of the particular fund over the last few months, as well as the last year, we can see quite an attractive performance and certainly a rebound from what we witnessed in technology in 2022. So although the last month we've seen a slight dip in tech, as well as global markets, year to date, we've seen a pretty staggering performance. So in Malaysian ringgit terms, we've seen performance of the fund in the MYR class of 31.22%. So if you compare this against your broad market, so here's an Islamic version of that market, MSCI Acquia Islamic, at a 20.60% return, you can see quite a staggering around 10% plus outperformance of the market. If we look at the long term, so if we look at a slightly longer period, given the inception of the strategy, we can't look back into a 3 or 5 year period, but if we look at a 1 year period, we can also see that we're about on par as compared to the broad market. So 7.85%, 7.89, which we're pretty happy with considering the huge drawdown in technology we witnessed in 2022. We can already see that the recovery year to date has started to offset that terrible performance we saw last year to create an overall good performance for the fund. And of course, if you look at shorter term periods, 3 months, a huge outperformance versus the market, 15.09 versus 8.96, and then 23.34, 17.74. So if you remember on slide 2, or slide 3, sorry, I showed you that 11 out of the last 15 years, tech has outperformed the market. Well, that's the same sort of pattern which we're starting to see again in 2023. If we look at a relative comparison of fund versus peers, we can also see a pretty attractive positioning. So what you see here is a Lipper peer table as of 21st of July 2023. So the same sort of time period we're looking at all these numbers for. And you can see that the top of the table's 1 year ranking is at 21.37% return. So we've seen that over the last year, that return has managed to put this fund as the leader in terms of Islamic global equity in the Malaysian marketplace. So outperforming all the other funds you see underneath. So some of those are pure technology funds, which we are outperforming, and some of those are obviously, more generic global equity funds. So we're pretty proud to be outperforming all of those. In terms of the portfolio, we can also see how we're currently allocated. So predominant allocation in the United States as well as Japan, and then a very small allocation to Europe as well as other markets. Why such a big allocation in the US and Japan? This is a question we often get asked for clients. This is really where market cap within the tech sector is. So it's not too different from the benchmark that we have, the MSCI ACWI Information Technology. If you look at where the market capitalization of the technology sector is, it's predominantly based in the US and Japan. With time, obviously a lot can change. Technology can start growing a lot more in other markets, but currently, if you look at the United States, it seems to be dominating the market capitalization of the technology sector. So the fund, by not deviating too much from the market, also follows suit and having predominant allocations in the US and Japan. On an industry level, so obviously here there's no need to show sectors because we're only looking at one sector. But if we look at one level deeper and look at the subsectors, which we call industries, you can start looking at what's making up that portfolio. So instinctively, they make a lot of sense, right? We have software at the start, software as a service. Remember what I said on that previous micro slide about having very scalable business models, high profitability, high cash flows. So it makes sense that we're heavily allocated there. Second biggest allocation, semiconductors. I'm sure a lot of you have seen the news, the growing need for semiconductors based on the adoption of AI as well as other technologies and a need for more advanced computing. And then we also have some other industries like IT services, hardware, so you can see here equipment, and then professional services, media, etc. The fund allocates between 50 and 60 stocks, but here, it wouldn't be a comprehensive session if we didn't give you a snapshot of the top 10 holdings. So as of June, we have here a snapshot of the top 10 holdings. And then what you can see here is some hardware as well as some software companies. You can see some chip companies, etc. So what's a bit different about this fund as compared to other funds is we don't hold a lot of concentration risk. So you can see here the NAVs, they're all quite low weights. So that's very different to some of the other funds we've noticed in the Malaysian marketplace that hold up to 5 to 10% in Microsoft, another 10% in Apple. So if your client wants alternative exposure in tech, if they believe that maybe the FANGs are very overvalued, they want to start allocating to all those tech stocks which haven't quite caught up, but for which there's very good business cases to invest into them, this is really the fund for them. So we've got a lot of positive feedback recently from clients that they really like this fund because they're fed up of the tech funds who only invest into Apple, Microsoft, Tesla, etc., which are extremely, have very high valuations at the moment. And they like this fund because it provides exposure to those tech stocks, which often don't get allocation and therefore are relatively, as compared to the FANGs, a bit more undervalued. Great. So before I wrap up, and I'm on time, 29 minutes past, I just want to provide a quick recap of the positioning points of this fund. So to start off with, it's a Sharia compliant fund that gives exposure to the technology sector globally. So that's very unique. It was really the first fund in Malaysia to do so, to provide Sharia compliant exposure purely towards technology stocks. So we noticed a lot of clients were asking for this, and therefore as a reaction So demand, we launched this product. The second is it uses a purely AI-driven process towards investing. So when calculating which stocks to invest into, the stock attractiveness, as we call it, the stocks most likely to make us money, we use a purely AI-driven process. So we look at fundamental data, we look at macro data, we look at analyst estimates, we calculate that mass of data, so there's millions of data points, using a number of machine learning models, and then calculate the expected return based on those models of a stock going up or down over the next month. And if a stock's got a high probability of going up, that stock's likely to make us money, and therefore we are likely to pick it for inclusion within one of our portfolios. Thirdly, it also integrates ESG. So I spoke to you a bit about the business case for environmental social governance and sustainability in general, why we integrate sustainability in the investment process. So of course, if your clients are interested in this from a performance or a value standpoint, this is a sustainable fund. And then finally, it's got a strong emphasis on risk management. So we play a slightly different game to the other fund houses in Malaysia. We don't just allocate into a basket of FANG stocks with very high weights. We have 50 plus stocks allocated, in a pretty diversified manner across industries as well as regions. And then we also have a strong emphasis in terms of ensuring that we don't take on too much risk or in times of stress or drawdown, etc., through implementing a mean variance optimization at portfolio construction. So to sum up, Sharia compliant, AI-driven process, ESG integration, and strong emphasis on risk management. So with that, I'm more than happy to open up to Q&A. Thank you very much for listening today.
Thank you, Mr. Nicholas, for your very insightful presentations. We will start our Q&A sessions. So we've got a few questions from the floor. The first one, what is the major difference between the funds with the other technology funds?
Yeah, so I've spoken a bit about this today, but I think it's a great question, Harriet, so thank you. So I think if you look at some of the other technology funds out there, they're very good funds, but they play a slightly different game as the one that we play. They are a bit more opportunistic. They take what we call concentration risk. So that's bets, very concentrated bets on particular names. These names tend to be FANGs. And therefore, when these companies do well, the funds do very well and the investors do very well. The issue is when these stocks do badly, the funds do very badly and investors lose a lot of money. So this is the classic, risk return trade-off, that if you are prepared to take on that sort of level of concentration risk, then maybe that's a fund for you. But if you prefer something a bit more diversified, something that's still quite opportunistic, giving you exposure just to tech, but still got an emphasis on risk management, going to protect your money a bit more so, then this is a very attractive fund. So we got that feedback a lot from clients last year, where there was a big sell-off in tech. And because we took less concentration risk, because we were more diversified, we outperformed significantly in those stress periods as compared to the other tech funds out there. So really, depending on what your clients are like, if they're looking for something that's a bit more safe, while still giving that opportunistic exposure to tech, then this is the fund for them.
Okay, so the next questions. My perceptions of AI stock picking is too quantitative. You may buy and sell a stock maybe within a week. So how long-term is your holding usually?
Excellent. So thank you, Nessa, for that question. You're right. If we are unconstrained and put no rules around our AI process, then because we look at a daily forecast, we could be trading in and out of stocks on a very regular basis, and that would be detrimental in terms of transaction cost and turnover. So at portfolio construction, we also impose a lot of rules on AI, so we don't just have AI unconstrained. We also impose rules to manage transaction costs, manage risk, manage turnover. And therefore, the average holding period for our stocks aren't just a week. They're anywhere between 4 to 6 months, possibly even longer, going up to a year. So we do stay relatively long-term in terms of our investment process. Short-term enough to take advantage of quick turns and rotations in markets, but also long-term enough in order to drive value from the stocks we invest into, as well as incur not too many transaction costs. So in summary, we don't trade weekly, on a weekly basis for every stock. We don't have a holding period of a week or a day. We trade, on a monthly basis in terms of rebalancing, and the average holding period in terms of the stocks we hold is anywhere between 3 to 6 months, but as far in some cases as a year.
Okay, how long is the minimum period to keep the funds?
That's very much up to you and your clients. Personally, for a fund like this, which is a bit more risky than a global diversified all sector equity fund, you want to have that holding period as long as possible. So I understand that the nature of clients is slightly different in the Malaysian marketplace as compared to other markets. But I think most research and academic evidence would suggest that when you invest into equities in general, you should have a holding period of at least 3 to 5 years. And I would say with this fund, personally, I would say even longer. But I understand that in Malaysia, things are slightly different. The investment periods tend to be slightly shorter. But I would really stress that with this particular fund, because it is that slightly more opportunistic, sectorial exposure, you could even call it thematic, investing just in the theme to do with tech, you want to have as long a holding period as possible. So I would say definitely over a year, if possible, longer.
Okay, we also get another question. So why does the funds use ESG? Isn't that bad for performance?
Excellent. Thanks for that question. So in terms of our philosophy at Arabesque, when we started in 2013, we did a lot of research on this topic, and the research was between sustainability and the future financial performance of a company. So disclosure, we never implemented ESG to start off with because we really wanted to save the world or impose any views on our clients.
How does the strategy work?
We really thought there was a big performance benefit in terms of integrating ESG into the investment process. So in 2015, we partnered with Oxford University, it's the University of Oxford in the UK, and produced one of the most cited studies on this topic. So we looked at 200 plus research papers on this link, and we found that in 80% plus of the cases, approximately, there was a strong link between sustainability, ESG, and future financial performance of the company. And this is why we integrate ESG into the investment process. So one example I like giving my clients is that a few years ago, when Facebook had the big Cambridge Analytica scandal, and that led to a big drawdown in Facebook's share price, if you looked at 1 or 2 years prior, you could actually see a decrease in the ESG score of Facebook as a result of social elements, and in particular, data privacy. So actually, if you used ESG data at the time, you could have underweighted or even removed Facebook from your portfolio and therefore not been impacted by that share price decline. So in the case of our funds, that was exactly the case. We noticed a few years prior to the Cambridge Analytica that Facebook's social score and data privacy scores were coming down. We excluded Facebook from our fund, from our investment universe, and therefore from our fund. And therefore, we weren't impacted by the Cambridge Analytica scandal when there was a big wipe out in terms of Facebook's share price. So that's one example of how ESG integration can help performance either from a risk angle or return angle.
Okay, so how do you measure an ESG score?
Great. So in terms of the ESG analysis that we use ESG data from our sister business, ESG book. So in 2017, as a reaction to the quality of the data we were finding, we found that the data wasn't that great in the marketplace. We created our own proprietary data set, and then a couple of years ago, spun that off. And today, that's one of the largest independent data providers in the world of sustainability data. And at Arabesque, we utilize that data in our investment process. How does it work? It follows a completely quantitative process. So it looks at a number of different data sources. It looks at sustainability reports of companies. It looks at integrated reports. It looks at NGO data. It also looks at news articles, so if there have been any controversies in the news. It processes that, normalizes that using a number of quantitative algorithms, and then calculates various scores. So one score is the environmental social governance score. Another score is the United Nations Global Compact score. We also look at a number of sub-scores as well as more granular feature level scores. And essentially these scores measure different things. So if you look at ESG, we really see that as a measure of management quality and corporate strategy from a non-financial dimension. If you look at the United Nations Global Compact, this is more how companies are behaving. Are they in line with the core principles of the UNGC? Are they behaving themselves, etc.? And these are the types of scores that we then use within the investment process of our fund when defining the investment universe.
Okay, the next question. So when is the best time to invest and how many stocks in the funds?
Excellent. So when is the best time to invest? Once again, what we've learned from studies and numerous studies time and time again, it's not just me, it's anyone who would give a session like this would say you can't really time the market. Yeah, a lot of people have tried, and all research suggests that timing the market is a fool's game, and it's better to just be very disciplined when investing and take a very long-term view. And this is the philosophy that we give to our clients. And actually, if you look at earlier this year, there's a great example of this. I was traveling to KL at the beginning of this year. I did a lot of client events on this particular fund, the BGSEA fund, and clients were all laughing. Yeah, they said now is the worst time to invest into tech. Tech's terrible. 2022 tech was in a massive drawdown. Interest rates are going to go up higher. Now is the worst time ever to invest into tech. Now, I've just shown you on the previous slide, tech's had a great year so far this year, right? So that's where a lot of commentary that was coming out did suggest that it was a terrible time to invest into tech. But what happened? Tech did really well. So what I'm going to say to you is that you never know when it's going to be that winning year. What I will tell you is that there's very good rationale long-term to invest into tech. And actually, if you look at the long term, and if you look at the last 15 years, 11 out of those last 15 years have outperformed the broad market technology. And there's very good rationale as to why, either from a macro or a micro standpoint. So that's the sort of philosophy that I'll give to our clients when investing into tech. You never know when it's the right time. Just think about the key drivers as to why tech could continue to go up. If you believe in those and they make sense, then perhaps now is a good time to get exposure to the technology sector. And of course, BGSEA is our answer to that, doing so in a Shariah-compliant, ESG integrated way. In terms of the second question you asked, how many positions? Really, it could be anywhere between 50 and 60 counters, depending on the rebalancing. So we rebalance monthly, and we can really choose anywhere between 50 and 60 counters, depending on the portfolio optimization.
Okay, this is the last question from the floor. How does the strategy works out which stocks to pick for the portfolio? Does it rely on the analyst view?
Yes, so we're a bit different to other fund managers in the sense that we adopt a purely quantitative AI-driven process. So we don't actually rely on any analyst or PM views. Instead, we adopt a purely AI-driven approach towards selecting stocks for inclusion in the portfolio. So I'll give you a bit more detail on how exactly this works. We look at any data points that potentially impact future financial performance. So these could be fundamental, these could be technicals, these could be analyst estimates. We then process that using a number of machine learning models. So machine learning sounds very confusing. Essentially what machine learning is pattern recognition, finding patterns in data and using those patterns to identify future possible value in those companies from a performance standpoint. And then we bring together those predictions, the best of those predictions together to have an overall prediction of whether a stock's going to go up or down over the next 1 month. And this prediction is done on a daily basis for 25,000 stocks. And that's what influences our stock selection in the investment process.
Okay, we have another question here. Are there any margin of error since the fund is using AI to invest?
Of course, what we definitely don't have here is the holy grail where we're going to outperform every single time and our accuracy of our signals are 100% correct. If we had done that, you guys would definitely know. But what we do see is value as compared to a kind of more traditional quantitative process or a more fundamental type process. So we're definitely not right in our prediction 100% of the time. There is definitely a margin for error. But what we see on average for our robust testing in different markets, whether they're on sectors, whether they're in countries, is that we tend to do better than we do worse. And that additional benefit in terms of doing a bit better than you are worse provides a lot of benefit in terms of overall performance at portfolio construction. And when we test the accuracies of our models versus a more kind of quant-based process, we see also quite a lot of benefit in terms of performance. So there's definitely going to be some error. We haven't got the silver bullet, but what we do have is a system that tends to perform well enough in order to drive significant value for our clients. And then I saw another interesting question from Evelyn around momentum. So this fund is not a momentum fund. So I would call momentum quant 1.0. So using very kind of more basic statistical algorithms to identify companies with a persistent trend in price, and then using those indicators to then select the companies with the highest kind of momentum performance. That's what we used to do at Arabesque a number of years ago. Over the years, we've developed our models towards artificial intelligence. So we don't just rely on momentum indicators. We do take momentum as an input, but we also take hundreds and hundreds of other indicators also as inputs. So the output for this, what this means for you and your clients, is that our model is a lot more dynamic, it's less assumption-based, and it's able to respond to different market regimes. So there's a market regime that's terrible for momentum. Our fund can quickly react and start looking at indicators with nothing to do with momentum in order to still profit for our clients. So it's a lot less assumption-based than traditional quant models, which just look at momentum indicators.
Okay, we got a question from Facebook as well. So is the fund managed by AI or human?
AI. So the portfolio manager is, of course, a human. It's Dr. Hans Robert. It's Razak in BIMB investment. And then on our side, our investment team, we have a team of researchers as well as an implementation team. And then, of course, BIMB investment locally has their own team of portfolio managers for oversight. So they are humans overseeing the whole process. We do have a strong risk management framework. We have an investment committee. We have human PMs, analysts, etc. But the actual process that we're supervising is purely AI driven. Yeah.
Okay, seems like all the questions are answered. So if you have further questions, feel free to send us an email at investhelp.my@fundsbermat.com. So link is at the chat box of, okay, a replay of tonight's session will be available right after this. So head over to our YouTube page at FSM1 Malaysia to catch this replay. So we thank you very much, Mr. Nicholas, for joining us today. And thank you, everyone, for attending tonight's sessions. Thank you.
Thank you very much, Harriet, and thank you for everyone dialing in this evening. Thank you.
Yeah, thank you. Good night.